Dubai has been sold to us as this perfect place. No taxes, luxury lifestyle, influencers moving there, people building wealth. It's almost felt like Dubai was untouchable. But now I'm seeing videos and reports saying tourists are leaving, and some people are even saying they're not coming back. So the question is this just social media exaggeration, or is something actually shifting in Dubai right now, especially when it comes to money, real estate, and global movement? Let's talk about it.
The most famous hotel in the world was fully booked, 94% occupancy. Lines at the Burj Khalifa from the moment it opened. Private yachts crossing the marina every 5 minutes. Dubai was, without any argument, the #1 tourist destination on the planet. Today, those same hotels on Palm Jumeirah and downtown Dubai, they're running at under 20% occupancy. Under 20%. Can you imagine that? Empty hallways in 5-star palaces that charge up to €800 a night. Luxury boutiques opening in the morning with not a single customer. Infinity pools as far as the eye can see, and nobody in them. And hotel managers, for the first time in years, slashing their rates by 40% rather than watch their rooms stay empty. How is that even possible? How did a city that had just posted its 3rd consecutive record year crash into freefall in a matter of weeks? And the bigger question, is this temporary, or has Dubai just lost something it may never get back? What you're about to discover in this video isn't just a slowdown. This is the story of a city built on a dream, and the moment the rest of the world decided overnight to stop believing in it.
Okay, so let's be real for a second. Dubai didn't just grow randomly. It was marketed very well. It became the symbol of wealth, freedom, and opportunity. You've got investors moving there, entrepreneurs relocating, people talking about tax advantages like it's a cheat code. And when you see that level of growth that fast, it attracts attention. But here's the thing people don't always think about. Anything that grows fast can also shift fast.
To understand the scale of what's happening, you first need to understand just how high Dubai had climbed. In 2023, the emirate welcomed 17,150,000 international visitors, a record. Tourism professionals around the world couldn't believe it. Nobody expected numbers like that so soon after the pandemic. But Dubai had done something very few cities have ever pulled off. It turned COVID into a launch pad. While Europe was closing its borders, Dubai stayed open, and high-end travelers looking for somewhere to breathe converged on the Gulf in massive numbers. In 2024, the figure jumped to 18,720,000 visitors, a 9% increase. Western Europe remained the #1 source market, 20% of total arrivals, up 14.8% year-on-year. Hotel occupancy climbed to 78.2%. Dubai's Department of Economy and Tourism, the DET, was talking about a new golden era. Then 2025 confirmed everything. 19,590,000 visitors, 5% more, a 3rd consecutive annual record. In December 2025, Dubai welcomed over 2 million tourists in a single calendar month, a first in its history. New Year's Eve, 94.1% occupancy, a level that hadn't been seen in 20 years. Europe, the UK, the United States, all growing. Luxury hotels weren't even bothering to cut prices in the off-season anymore. Dubai had stopped being just another destination. It had become the global symbol of aspirational travel. And that's exactly why what happened next hit so hard. Because the higher you climb, the more visible the fall. But before the collapse, there were already cracks. Quiet ones, almost invisible in the official numbers, but real. Early in 2025, a troubling trend starts to appear in certain segments of the hotel market. Luxury properties, the same ones that had seen a 3% occupancy increase in 2024, were watching their average daily rate drop by almost 2%. In plain terms, they were filling more rooms, but at lower prices. Guests were starting to compare, negotiate, hesitate. And all the while, something far more dangerous was taking shape just a few hundred kilometers away. Saudi Arabia had been pouring staggering amounts of money into transforming its tourism image for years. Vision 2030, that's the name of the program. And the numbers are mind-blowing. Over $800 billion committed to tourism investment. Neom, an entire city built from scratch on the Red Sea coast, featuring a 170-kilometer linear urban belt called The Line, running entirely on renewable energy. The Red Sea Project, pristine islands, untouched beaches, 8,000 hotel rooms across 50 luxury properties, and a mountain ski resort for travelers who no longer wanted to fly to Switzerland. Above all, a national marketing budget multiplied by 3.4 since 2022. Targeting exactly the same affluent travelers who had been filling Dubai's hotels for a decade. On the other side, Western tourists were quietly starting to change their tune. On Reddit, on travel forums, in YouTube comments, one word kept coming up more and more often to describe Dubai. A word that's deadly for any tourist destination. Artificial. Entire threads. Was Dubai actually worth it? Where the majority of responses were increasingly discouraging. Travel influencers with millions of followers starting to walk back their enthusiasm. And then, suddenly, a disturbing new hotel trend. Hidden fees, pool surcharges, mandatory resort fees. Services that used to be included in the room rate now billed separately. It got so bad that the UAE Ministry of Economy had to launch a crackdown. Over 500 violations were recorded in the first few weeks of 2026 alone. All of that was the kindling, the hidden fragility beneath the golden surface. And then, in the space of a few days, everything ignited.
Now, when people hear tourists are leaving, they think it's not a big deal, but tourism is money. That's hotels, restaurants, shopping, experiences. That's cash flowing into the economy every single day. So if people are saying, I'm not coming back, that's not just a travel decision. That's more money deciding to go somewhere else. And when money starts moving differently, everything connected to it starts feeling it.
Late February 2026. The geopolitical situation in the Middle East breaks. Tensions between the United States, Israel, and Iran, simmering for months, reach a breaking point. Military strikes are exchanged. Airspace closures cascade across the entire Gulf. And Dubai International Airport, the world's busiest for international passenger traffic, finds itself at the center of the chaos. To understand what happens next, you have to realize one thing. Dubai isn't just a tourist destination. It's a hub, a global crossroads. Thousands of connecting flights pass through its airport every single day, linking Europe, Africa, Asia, and the Americas. When Gulf airspace becomes uncertain, it's not just Dubai that gets hit. The entire global air travel network has to reorganize. And within hours, the cancellations start pouring in. Emirates Airlines, Etihad, British Airways, Lufthansa, Air France. Hundreds of flights canceled, delayed, rerouted. Travel times for flights forced to detour around the conflict zone swell by 2 to 3 hours. Available ticket prices spike. And the question millions of travelers start asking on their booking apps is simple. Does it make sense to fly into a region sitting a few hundred kilometers from an active armed conflict? For most of them, the answer is no. Not because Dubai is dangerous, not because the UAE is at war, but because risk psychology doesn't run on pure logic. Western governments start issuing travel advisories for the entire Middle East region. And when a government says, exercise caution. Families on holiday tend to listen. The results come almost immediately.
So here's something you have to understand. Money doesn't like uncertainty, whether it's geopolitical tension, conflict, or safety concerns. Even rumors can shift behavior. And investors, they don't wait around. They move early. So if there's even a perception that something might be off, people start pulling back. And it doesn't always happen loudly. Sometimes it's quiet, less bookings, less movement, less demand. Until one day people look up and say, wait, something here has changed. So let's finish watching the rest of the clip.
In March 2026, hotel bookings in Dubai are cut in half compared to February. In half. In a single month. Flight bookings collapse by 80%. The World Travel and Tourism Council, the WTTC, releases an estimate that stops people cold. The conflict is costing the Middle East tourism industry at least $600 million per day in lost international visitor spending. $600 million per day. On Palm Jumeirah, one of the most upscale areas in the world, 5-star hotels watch their occupancy collapse to under 20%. Properties that were running at 85% just 3 months earlier. Hotel managers who, for the first time since COVID, find themselves offering discounted staycation packages to UAE residents just to get some bodies in the building. And for Dubai, tourism isn't a side business. It's the backbone of the entire economy. 12.2% of GDP from direct contributions alone. 21% when you factor in the ripple effects on real estate, retail, and hospitality. When tourists disappear, it's not just hotels that suffer. An entire chain of economic value seizes up. Tour operators like TUI start suspending or scaling back their Dubai packages. Hotel construction projects go on pause. Investors with commitments in new luxury developments start asking questions nobody can yet answer satisfactorily. But here's what most of the analysis isn't saying. What's happening to Dubai in March 2026 isn't just the result of the regional conflict. It's the perfect intersection of 3 simultaneous crises that nobody anticipated at this scale. A geopolitical crisis cutting off air travel. A value perception crisis eroding the loyalty of premium travelers that had been building for months. And a structural competitive crisis. Saudi Arabia, with its near unlimited resources, silently absorbing the same clientele. 3 crises at once, and Dubai has to face all 3 without a safety net. Industry insiders willing to talk off the record describe an atmosphere of quiet panic in hotel boardrooms, emergency pricing reviews, crisis repositioning, and one question circling on repeat. Are we living through a temporary shock, or has the world just decided to see Dubai differently, permanently? Because if it's the second option, the consequences go far beyond occupancy rates. Dubai's hotel infrastructure, tens of billions of dollars invested since 2018, was built on a projection of continuous 9% annual growth. If that growth doesn't come back, some economists are starting to use a term dreaded in the investment world: stranded assets. Infrastructure that can never generate the returns it was built to deliver because the market conditions have fundamentally changed. And that's a problem no marketing campaign or rate cut can fix on its own.
Now let's talk about real estate, because this is where it really matters. Real estate depends on demand. You need people moving there, investing there, renting, and buying. But if fewer people are coming in and some people are leaving, that demand starts to drop. And when demand drops, prices just don't stay the same. They have to adjust. And sometimes they drop fast.
Here's the truth Dubai didn't see coming, or maybe chose not to see. For a decade, this city built its entire tourism model on one promise: frictionless hyper-luxury. Come, spend, be amazed. Dubai has no ancient culture to sell, no stunning natural landscapes, no globally iconic local cuisine. What it sells is managed excess. The artificial Palm Island, the ski slope in the middle of the desert, the sailboat-shaped hotel. Everything that is the biggest, the tallest, the most expensive. And for a long time, it worked brilliantly. But the data shows that the preferences of affluent Western travelers have been shifting for years. A KPMG study on UAE tourism found that 94% of visitors said they were satisfied with their hotel stay in 2025. 80% said they'd come back. Incredible numbers on the surface. But dig into Google Trends, travel forum discussions, conversations in luxury travel agencies, and one question keeps surfacing. What does Dubai offer that I can't get somewhere else? For less money and with fewer geopolitical worries. Saudi Arabia understood that vulnerability before anyone else. The Red Sea project isn't just another luxury resort development. It's a calculated, direct response to everything Dubai is missing. Virgin Islands, not artificial ones. Protected coral reefs, a commitment to increasing biodiversity by 40%. A promise of authenticity that Dubai, with its glass towers and choreographed fountains, simply cannot deliver. And behind it all, an investment capacity that even the UAE can't match. $800 billion committed. A national tourism budget multiplied by 3.4. A strategy that explicitly targets the same high-net-worth European and American travelers who have been the backbone of Dubai's tourism for 10 years. But there's something even more revealing. Brace yourself. Luxury travel agencies in European capitals describe a transformation that accelerated through 2025 and especially into 2026. Their most affluent clients, the ones spending between 15,000 and 50,000 euros per vacation. They're not spontaneously mentioning Dubai anymore when listing their dream destinations. Not because they hate Dubai, but because it has slipped in their mental map from "I absolutely need to go" to "I've already done it." And in the luxury travel industry, once a destination loses that aspirational status, the road back is the hardest journey there is.
Now, this is the real conversation. Was Dubai growing too fast? Because if you look at the signs, rapid development, luxury everywhere, global money pouring in, that can be a good thing, but it can also create a bubble. And bubbles don't pop when everything feels good. They pop when sentiment shifts, when people stop believing the story. So the question becomes, are we starting to see the early signs of that shift?
Dubai is not without resources. Far from it. The Emirate has survived comparable crises before. In 2008, when the global financial crisis brought Gulf real estate projects to a grinding halt, analysts announced the end of the Dubai miracle. In 2020, COVID brought global tourism to its knees, and Dubai bounced back faster than almost any other major destination, reopening as early as the summer of 2020. The UAE's resilience is real and well documented. The government has already responded. Hotels are deploying what they're calling reassurance marketing, communicating stability, UAE security, and the Emirates' operational distance from the conflict. The DET is maintaining its long-term targets, 40 million annual visitors by 2031, within the Dubai Economic Agenda D33 framework, which aims to double the Emirates' GDP within a decade. Tailored tourism packages are being offered to regional residents.
And this is what I really want you to understand. So this is not just about Dubai. This is about how money moves globally. People go where they feel safe, supported, and they feel profitable. When one place starts losing that energy, money doesn't disappear, it relocates. So while people are focused on what's happening in Dubai, smart people are asking, where is the money going next?
And trade negotiations are underway to develop attractiveness in Asian markets, particularly China, which had posted a 7% increase even during the period when Western numbers were softening. But economists point to a structural limit in that logic. A Chinese visitor spends on average 22% less per day than a high-end Western traveler. To maintain tourism revenue in a scenario where Westerners are scarce, Dubai would need to attract dramatically higher volumes of Asian visitors. That would require a profound shift in its offering. Less ultra-luxury positioning, more accessibility. A repositioning that would take years and would risk alienating the very premium travelers who might return once the crisis passes. It's the classic tourism turnaround dilemma. The decisions you make to survive the short term are exactly the ones that undermine the long-term model. And while Dubai is finding its footing, the neighboring kingdom keeps moving forward. Saudi Arabia, having already surpassed its initial target of 100 million annual visitors ahead of schedule, isn't slowing down. The Red Sea project brings new hotels online every quarter. NEOM, despite controversy over labor rights and questions about economic viability, with profitability not expected until 2040, continues to dominate the global imagination with an aggressive marketing push. And the real question, the one nobody in the financial press dares to ask directly, is this: is Saudi Arabia in the process of permanently capturing market share that Dubai spent 20 years building? Here's what's fascinating about this story, and unsettling. Dubai didn't make a fatal mistake. It didn't mismanage its economy. It didn't miss a technological shift. It didn't lose a trade war through incompetence. What's happening to it is something far harder to fight: a loss of control over its own narrative. For 20 years, Dubai told a story. The story of a city that turns the possible into the real. Desert into dizzying heights. Emptiness into the superlative. And that story worked because the Western world wanted to believe it. Because conspicuous luxury matched what affluent travelers wanted to project on their social media. Because the artificial was embraced, even celebrated. But something has changed. In behavioral data on high-end travelers, a structural shift has been building since 2023. Status travel, the kind you do to be seen in Dubai, is losing ground to meaningful travel. The search for authenticity, connection with nature, irreplaceable cultural experiences. Destinations like the Maldives, Bali, the Greek islands, Patagonia, places that offer something Dubai architecturally cannot. A reason to go that isn't the hotel itself. And that's where the real twist is. What threatens Dubai in the long run isn't Saudi Arabia. It's the end of conspicuous travel as the dominant aspiration. The world has changed. And Dubai, extraordinarily good at adapting to almost everything, is facing, for the first time, a shift you can't buy your way out of with a new skyscraper or a billion-dollar attraction. The city can recover from the crisis of March 2026. It has before. The UAE's resilience is real, documented, and genuinely impressive. But the Dubai that emerges on the other side probably won't be the same one that existed before. And maybe, just maybe, that's exactly what it needed. The question now isn't whether Dubai can survive this crisis. It's what it will choose to become. A city that keeps selling the same dream to a shrinking audience. Or a city that reinvents itself, once again, by understanding that the world has moved on, and that tomorrow's travelers are looking for something more than gold-plated concrete. Dubai built the tallest, the biggest, the most expensive. What it still needs to build might be the most honest.
At the end of the day, Dubai might recover, it might not, but the bigger lesson is this: you can't build your entire strategy around one destination, one trend, or one moment. You have to understand how money works and how to position yourself in this economy and how to move with the shifts. That's how you stay ahead. Like, share, and subscribe, and thank you for watching.